Hello, I'm Rosanne DeTorres, and I'm the managing partner of DeTorres and DeGeorge Family Law. This video is another in our series of showing our clients how we do 360 degrees of care. Here at DeTorres and DeGeorge Family Law, we know that divorce and family law clients often need more than just legal advice. That's why we partner with different professionals that can guide you and offer you services that can assist you in your journey through the legal process and beyond. Today, I have with me Christine Cox-West of the Fortis Agency. Welcome, Christine.
Thank you for having me.
Please tell us a little bit about you and what you do.
Yeah, I'd be happy to. So I'm a partner at the Fortis Agency. We're a wealth management and financial services firm, and we help individuals and business owners take advantage of unique strategies. And we also help other advisors implement those strategies for their clients as well as a resource to them. Awesome.
So one of the things that I know is a specialty of yours is life insurance. So when somebody going through a divorce has to buy life insurance, how do they know what kind to buy?
That's a great question. And I'll start off by saying that everyone, regardless of if they're divorced or not divorced, especially if you're a parent, you're married, you need life insurance. When people start going through the divorce process, that's when it becomes apparent, oh my gosh, I need life insurance to protect alimony, child support payments. That's really where we see a lot of life insurance put in place, maybe begrudgingly. And when it comes to what kind, and that's really what the article I wrote about was, there's various kinds of life insurance out there, and knowing what kind to buy and how much to buy becomes a big question. So when it comes to how much, we want to evaluate, what do the alimony and child support payments look like over time? And if a parent was, an ex-spouse was to, let's say, pass away yesterday, how much would they have needed to have in a pot of money to pay out those payments? And that's really where we come to how much. And then what kind? So the cheapest kind is term insurance, and that's what people usually purchase. So if you have to pay alimony payments for 18 years, let's say, you might purchase a 20-year term policy because the terms are usually in blocks of years, like a 10-year term policy, 20-year, 30-year. So we get a number close to the number of years we need to make payments. That's very cheap, and it's very cheap because most of those policies don't pay out. Only about 1% of term policies pay out. 99% of people live, and we hope they live, right? And in those horrible situations that they do pass away, it's really important that life insurance is there to keep those payments going to support that family. Now, if a person has, go ahead.
Oh, I was going to say, and with term life insurance policies, they usually expire before you get old. Most people die. That's one of the reasons they don't ever pay out, except in 1% of the time, because they're usually like 15-year term. And by then you're, maybe in your 60s, and it becomes much more expensive to buy life insurance when you're in your 60s.
Absolutely. And some carriers will allow you to keep that policy, but they jack up the rate so exorbitant that you won't take advantage of it. It's really only somebody that knows that they're terminally ill that will pay those exorbitant premiums. So yeah, you're absolutely right. Those terms expire, and if you don't die, you haven't, that's money out the door. That's a pure cost.
Yeah. What's an alternative then for people that don't want to invest in a policy like that expires and leaves them with nothing to show for all the money they put into the premiums?
Right. So there's permanent policies, there's universal life, there's cash value whole life insurance. And those are options if you have good cash flow that you can take advantage of, so that it's not if I don't use it, I lose it scenario, which we don't want to use because that means we die. And in those scenarios, like I said, if you have good cash flow, that's a great alternative. So my article talks about this in a situation of divorce, right? So an ex-spouse is told that they need to buy X amount of life insurance in order to cover those payments. Now, once the term of the alimony payments ends, that's money out the door that they spent on this life insurance. If they instead purchased a permanent cash value policy, at that end, they would now have cash value in the policy, and they'd also still have this policy. So they can change the beneficiary to their children, possibly a new spouse, they can surrender the policy and take the cash value, which would create a small tax consequence, but hey, you're still net positive. Or the more likely scenario is they keep that policy in place and then they use it as a part of their financial plan, and they can actually use some of that cash value to supplement their retirement income. So now this person that, would have spent all this money on term insurance and it's out the door, now they have a real asset, and they didn't spend any money on that term insurance because that ex-spouse didn't use it because they're still alive.
So how does it, like a whole policy work so that it grows in value? How does that work? Where do those dividends come from?
Yep. So the insurance carriers are investing their money in their own accounts, and it's very a lot of fixed income products. They're all conservative investments, a lot of real estate, and it's not correlated to the stock market. So unlike another asset that a person could have and lose, whatever your cash value gets up to, that's locked in at that point, and you can't lose it. Every year, dividends are added into your cash value, and that's how your cash value grows. And at a certain point in time, that spouse could even decide to offset the policy and no longer have to pay the premiums. The death benefit would at a certain point, as long as it's the contract stable, they can say, hey, I'm not going to pay these premiums anymore. The death benefit's there for my spouse. I'm kind of set.
And the policy's paid up, you don't have to put any more money into it.
Once it offsets. So offsets means the dividends can actually support the premiums.
Right, but then your growth isn't happening at the same rate.
Correct. It's not growing as fast, but for somebody that is using it to support alimony payments, they might not care about that growth right now. They really are worried about that contract once they no longer have this obligation of alimony payments.
Are the dividends on a product like that guaranteed?
There are guarantees within the product, so they'll have a guaranteed rate of return, the floor of the product, but then the dividends themselves are not guaranteed. What you want to look for in a contract when you're working with your financial advisor is look at what the historical dividends were for a carrier. A lot of times you'll see carriers that every single year they've returned dividends. So a carrier like that, I'm comfortable purchasing when I've seen their history. Obviously, history doesn't predict future outcome, but it's good to see.
Right, but there is a guaranteed rate of return.
Correct. Most of the time, you'll see like a guaranteed.
In addition to the potential for dividends.
Right, absolutely. So a lot of times you'll see like a guaranteed rate of floor of 4%. That's very common in these cash value products.
Now, is the growth in the policy tax-free?
That's a great question. So the growth is tax deferred, and then you can take the cash out of the product on a tax-free basis when done the right way. Oh. So if you surrender the contract, that would create a tax obligation event.
Because you get like a big lump sum of money, there's a taxable event there.
Absolutely, and that's why you want to hold on to these contracts. Because anything more than what you've put into the contract, that amount is taxable. Whatever you've put in is your basis. That's not taxable. But the additional money, that's what's taxable if you surrender the contract.
Okay, absolutely. But there's a way to defer the tax and take it out tax-free if you do it the right way.
Absolutely. And that's when you implement withdrawals and loans. And you never want to take out too much because then, again, there's that tax obligation. So you'll want to talk to your advisor when you want to take money out. But it's a great way of, especially for business owners or real estate investors, they have this money on the side. It's like being your own bank, and they can take it out as they wish and use it to make money on their money. They see an opportunity. They don't have to wait for a loan. They don't have to go to the bank. They take it out of their own bank, use it, implement it, turn that money, put it back in. And that's a great way of making multiple rates of return on the same money.
So give us some tips or advice that you would give to somebody going through a divorce. What are some of the things they should be thinking about when it comes to life insurance?
Yeah, so the most important thing, obviously, is protecting your children. I heard a great quote the other day, and I always talk about this, but the way it was said is, GoFundMe is not life insurance. That's not a good life insurance plan. And it's so sad to see some of these scenarios where we're raising money for a family whose parent passed away, and we're trying to replace their income, right? And they're never going to come even close in a GoFundMe page. If you take somebody's income, let's say $100,000, we'll keep it an even number, and they have 30 more years left to work, that's a $3 million asset when you don't even take into account inflation and raises. How are you ever going to raise $3 million on a GoFundMe page in your community?
Yeah.
It's not going to happen. So the most important thing is replacing that income. $3 million sounds like so much money to somebody that's never had it. But when you actually do the math and you tell a widow, you need to have this last the rest of your life, and we need to replace that income, they're net even. It's not like they have this huge windfall of money. That's just replacing what that spouse meant financially to them.
So it sounds like there's not just one way to go. There's different insurance products that you can use to provide protection to people going through a divorce or to secure their support obligations to their ex.
Absolutely. It's all on a piece-by-piece basis based on their goals, their cash flow, what they're looking to accomplish. Everyone's going to be different, and there's no product that's going to fix everything, right? So anyone that says this is the only way to go usually doesn't have your best interest in mind. Look for somebody that understands multiple products and is trying to find the right solution for you in an unbiased way.
Yeah, and then if you really are just focusing on cost in the near term, you can get a lower price policy, but then you could potentially increase your savings by moving into a different kind of product that has a savings component that you talked about.
Right, so that's what I do. I'll tell a little bit about what I personally do. When I got into the business, I didn't have kids, I wasn't married, I didn't own a home, and I just wanted to start saving. So I opened up a $250,000 whole life insurance policy that I pay into. I still pay into today. Then I got married, had children, and I needed a lot more life insurance, significantly more life insurance. And I purchased, I think at the time I purchased $2 million of term insurance. So it was something to help me. I actually laddered the policies so I could convert them over time in a cost-efficient manner into a cash value product. And then a few years later, I wanted more of a cash value product. Since I was still healthy, I reapplied. I didn't need to convert. I reapplied and I purchased another whole life insurance policy that I paid into. So I have a few $1 million of life insurance, different kinds of contracts. Again, there's no right policy for it's going to fix every problem. And usually, someone's calling me. Is it still filming? Are we still good?
Yeah, we're still good.
I'll decline it. Okay, cool. And usually it's going to be a number of different kinds of contracts that's going to be the right solution, because $3 million, $4 million, $5 million of whole life insurance for me is going to be expensive. But if I can break that up and have some whole life insurance and some term insurance, I'm accomplishing the need for my family if I pass away. And I'm also able to save in, a safe, conservative manner, which rounds out my full financial plan.
Great. So if our listeners want to find you, where's the best place for them to find you? How can
So our website is thefortisagency.com. Fortis is spelled Fortis. We're on Facebook at The Fortis Agency, Instagram at The Fortis Agency, and LinkedIn at The Fortis Agency. So those are all easy ways to find us. And I'm more than happy to help anyone that I can in this regard.
All right. How about your phone number for just you?
Yeah, 973-727-8707. And my email is cwest@thefortisagency.com.
Thanks so much. Thanks so much, Christine.
Thank you, Roseanne. You're the best.
Have a great day.
You too. Take care.